Welcome to Trading Nation. I'm Eric Chemi. Today we've got a special guest. I'm excited by it. Gershon Distenfeld. He's the Director of Credit at AllianceBernstein. Gershon, thanks for joining us here. And I want to kick it off. You say that people who buy high-yield ETFs may be making a mistake. Talk to us about this mistake.
Well, the reality is that the high-yield ETFs have been around for about a decade now, and they haven't lived up to expectations. You know, there's this assumption out there that all ETFs are passive, they're cheap, and they give you market beta over time. And in the case of many equity products, that is correct. When it comes to fixed income, especially the less liquid parts of fixed income, the numbers simply tell a different story. First of all, they're not that cheap. They're not the few basis points that you have some of the equity ETFs. They're either 40 or 50 basis points, which isn't that much lower than actively managed fees. And they just don't perform over time. The average manager, even after fees, has outperformed the ETFs, top managers, by several hundred basis points annualized.
So that's a really good point to make. That's one thing, like you said, ETFs in very liquid stocks, S&P 500 kind of names, maybe that's a different universe than the ETFs here with high yield bonds. And I want to break down into sectors a little bit. So if we've got this concept that maybe being a passive investor is not the way to go, and I want to be more of an active person in high yield, what are the sectors I should be focused on more?
Well, it's really, when it comes to credit, given the asymmetric risk of the downside, it's the sectors that you don't want to focus on. Think about the energy space, and this is part of the reason why, even if you could get passive returns, you probably don't want them. The more debt that a company or a sector issues, the greater the value is in the index. So think about it. The more leverage it gets put on a balance sheet, and all else being equal, the higher default probability, the higher it is in the index, the more that people have to buy it. Not just passive investors, but active investors as well, just to meet benchmark returns. So it's a little bit different than the equity side, and that's why that even, again, the passive ETFs in high yield actually don't even outperform their benchmarks. But even if you got that, that's not the kind of returns you necessarily want.
It is funny because in a way, sometimes in the markets, we over-obsess with stocks, and then that same intuition really just doesn't seem to apply at all when you're talking bonds, especially the high-yield bonds, right?
Yeah, that's exactly right. Look, on the surface, you're investing in companies, so you would think that you should have similar investment philosophies. But the reality is the profiles are completely different. On the equity side, I can afford to make a mistake. I could buy a stock and go down even 100% because the next stock I buy might quadruple in price or more. Given fixed income returns are just very, very different. You only get bonds that double in price after you've already had a problem. So if I make a mistake in fixed income, it becomes much costlier. And that's why in the equity markets, you're looking for undervalued situations. In the credit markets, you're looking to avoid the overvalued situations.
And so you mentioned, let's say, don't go with energy right now. Is there another sector that you want to highlight either on the positive or the negative side?
Well, in general, look, we think that the U.S. credit markets are pretty fully priced, and we think that now's the time to look outside the U.S., particularly in emerging market debt. You know, a year ago, it was the U.S. market that was dislocated. And, you know, in our flagship product, AB High Income, we had the overwhelming majority of the portfolio in U.S. high yield. Today, that's down to more like 40% because we're finding opportunities outside in the income space, in emerging market debt, some in Europe, and also in the structured mortgage markets.
Okay, so let's say, last question, real quickly. If I'm watching this, let's say I've never bought high yield before. I'm an investor who's mainly focused on stocks. Let's say I'm retail. How do I get involved? What do? Do I got to call a broker? Can I go online? Is there something I can buy? How does someone get into a new asset class like this?
Well, there are a lot of open-end mutual funds, which is probably the best way to access the asset class because it's so important to get diversification for the reason I cited earlier, that you have a lot of downside and not a tremendous amount of upside in any one individual situation. You're best accessing it through a pooled vehicle, and open-ended mutual funds are superior to the ETFs in this space.
Well, Gershon, it's been really great having you. Interesting conversation, some good things for people to think about. Thanks again for joining us here on Trading Nation. That's Gershon Distenfeld of AllianceBernstein. And thank you for watching. I'm Eric Chemi. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.